In this video, we're going to be talking about what happened to the stock market a couple of weeks ago with stocks like GameStop, AMC, and BlackBerry. And is this a trend that will continue in the future? Is this something that's transformative? And how will it impact the stock market in the future and the future of other retail investors? Over the last few years, investing platforms like Robinhood, Webull made it extremely easy for retail investors to invest in the stock market. The trend to get the retail investors invested in the stock market started really decades ago, and it continued on. But for the most part, you required some kind of computer in order to run the software or have enough screen space to really work out a trade and see what was going on. But this trend really helped the middle class that was working in an office setting, that had access to a computer. So they would be able to take a break in the middle of their day while the stock market was still on, and then be able to execute a couple of trades and adjust their trades during the day. So something that is not available to most people. You needed that computer, that big screen, in order to see what was the trend in the stock market in order not to make a mistake. The millennials were basically left behind on that trend. They would see the stock market and Wall Street as a really ancient institution, just like public libraries, museums, and the like. For millennials, the primary device is their phone. And Robinhood understood that and made an application that was really suited very well for millennials. The interface is super easy to use and execute trade and know what's going on at any moment. And as you know, millennials are on their phone all the time. They look at their device all their time, so they can execute these trades and then monitor their investments on a very regular basis. It also opened the trading to other groups of investors that didn't have access to a computer. So you could be an Uber driver, for example. It would be very hard for you to trade between rides. So now with applications like Robinhood, you're able to do that. So all these investors are doing trades. They're feeling more and more comfortable with trading on the stock market. And really, over the last 10 years, you couldn't do anything wrong on the stock market. The stock market has been going up pretty much. These users on the Robinhood platform and others were able to do some trades and feel more comfortable with the stock market. Over the last 5 years, the stock market has been going up, and the feeling of comfort turned into a feeling of confidence. So the users were feeling more confident about using the application, but also trading on the stock market and doing options, etc. Many investors felt and still feel like they're investing geniuses because they could do no wrong over the last 5 years. Every trade pretty much made money. So another thing that millennials are well known for is social media. So enter Reddit and the Wall Street discussion board, Wall Street Bets. Not many people had heard of the Wall Street Bets board. Its membership had grown steadily over the last 5 years. And in 2021, Wall Street Bets had about 2 million members that were discussing all kinds of trades and openly in public about what they thought they could do with this particular stock, with Apple, with Facebook, with Google, and others. In January 2021, the discussion seemed to focus a little bit more on some stocks like AMC, GameStop, BlackBerry that appeared to be severely shorted. So when a short is explained to the investors, they always explain it in a way that you basically borrow the stock from another investor and you sell it yourself into the open market in the hope that the stock price would go down and you can buy the stock back and put it back into the other investor's portfolio without him noticing. That is kind of how it's explained. But when you look at the recent trading that has happened, it's pretty obvious that in reality, it is a straight bet against the stock. You're basically having a negative stock, a negative quantity of a stock at a specific price, the price that you sold it at. That is your real position. So what have you sold? You haven't sold really. It used to be stock certificate. What happened to the stock certificate? Well, they don't seem to matter anymore. So basically, that's kind of the situation now, is that some of the investors reviewed these shorts, and they realized that the number of short position, the number of stocks that were sold was actually higher than the quantity of the stock of the company that the company had issued. This seems illogical, and it is to most investors and most people that are not professional investors, but it really only makes sense on Wall Street, where you can sell something more than what you actually have. It doesn't make sense anywhere else in the world. And by in the world, I mean other types of market, real market. So when this was discussed in Wall Street Bets board, a lot of these investors, a lot of these new investors, and some of them millennials investors, middle class, the regular retail investors, found that illogical. They really rallied against that idea and that concept that, hey, that doesn't make sense. How can they sell more than what's out there? That really helped kind of pull everybody, a lot of people into the trade and decide to take action. So they went on Robinhood and Webull and they started trading. They started buying these stocks and driving the price of GameStop and AMC and BlackBerry up. And that forced a lot of these short investors, people that have sold non-existent stock on the stock market, to cover their what is called cover their position, to buy back some shares of the company in order to close their position, in order to get rid of that negative quantity of stocks, because they didn't want to lose too much money. So that act also contributed to the rise in the price, because now they had to buy stocks at a higher price than they had sold it for, and so that forced the price of the stock even higher. So as the swarm of investors, of retail investors, made an impact and noticed that they made an impact on the stock market, it really attracted even more people. So now these were people that were not on Wall Street Bets, that were not on Robinhood, and that they decided to join into this movement, into this swarm, and that really blew up the stock prices. And social media was instrumental in really sharing and spreading that news, and the news spread like wildfire. And the membership of Wall Street Bets discussion board went up by 6 million users by the end of January. So this was a tremendous increase. As you know, they started at 2 million. The reaction of the professional investors and institutional investors, and also the moderators on CNBC, was absolutely priceless. They had no idea what was happening. They had no way of explaining what was going on, and all they could see that the stock price went up, and it's like, okay, I guess it's because people are buying. But they really were lost for word about what was going on. The market was working. The demand of the stock actually caused the price to go up and up, and but they had no way to explain what was going on, and how these professional investors were basically losing a lot of money because the retail investors decided to act together and focus on specific stocks. The thing is that for years, CNBCs and analysts and other people, they've been trying to influence the price of the stock by doing these analysis, these publications, going on CNBC and talking about why this stock price is not ridiculously high and why you should really buy it. It's kind of interesting, and now they just because it's the retail investors decided to push a specific stock and it went up, now it was kind of that doesn't make sense anymore because we don't have an analyst telling us that this value is higher. It highlighted a couple of things for me, is that Wall Street really lost track of reality and kind of has, in some instances, kind of lost common sense. The short position that we've seen was kind of to the retail investors appeared illogical and should have appeared as illogical as well for the professional investors. But sometimes you get so buried into these abstract concepts that you lose focus on what the common sense should be. Analysts have been trying to influence the stock prices for years for all kinds of different companies, and so in 2000, they were talking about how these dot-com stores, the value is there, you should really buy into these stocks and all of that, even though they were losing money and they probably would be losing money for the next 5 or 10 years, you should really buy in these stocks. That's what they were pushing the stock prices. The dot-com crash happened in 2001 because people realized that, hey, that doesn't make sense anymore. It lacked common sense. Why would I invest in a company that's losing money and it's probably going to be losing money for 10 years? It worked out for some of them, like Amazon, but it didn't work out for many other companies. And the thing is that some of these pricing is really devoid of common sense. So consider this company, for example. So this is a company that is a fictitious company. This is their revenue. Their revenue is $386,000 a year. Their profit is $22,899 per year. How much would you pay for that company? It's a company that's doing very well. They're very innovative. They have a good number of customers that are really loyal to that company. So how much would you pay for that company? It's making a profit of $22,899. You can see that they have a lot of costs obviously associated with that. Would you pay $1.6 million for that company? Seems a little high, doesn't it? If you paid $1.6 million for that company, your cash-on-cash return would be 1.4%. So obviously it'd be too much to pay for that company. But this is how much people are paying right now for Amazon. If you look at the numbers, these are the numbers, well, reduced significantly. Instead of 386,000, it's 386 billion. This is how much people are paying right now for this stock. Doesn't make sense. I know they have a little bit more to offer than just a regular store, but still, the valuation seems a little out of whack. So in conclusion, I think that the retail investors really got a sense that they could affect the stock market. Like they affected other markets as well, the grocery stores, some of the products. So they have made an impact. Voting with their wallet is much more powerful than voting with your ballot. And this is something that the retail investors and the general consumers is learning with this. Robinhood and platforms like these are making it simpler and easier for everybody to engage in the stock market, and discussion boards and social medias are making it easier for people to focus their attention on something that matters to them. This is similar to the activist investor, somebody that is really investing for a cause and sees something that they want to act on. Now we have the retail investors that could become movements or become activists and really impact a few stocks on the stock market when they decide to. And that's really the question. Will the retail investors focus their attention again on some stock? Will they take action on other stocks? I think Wall Street and the professional investors are anxious to figure out if this will happen, and so this is going to be something to watch in the future for sure. I hope you enjoyed this video and you learned a few things about the stock market and how it operated, as well as what happened with the GameStop and AMC and BlackBerry. If you like this video, make sure that you like it, you click that little thumbs up, and also if you're interested in investment, real estate investing, financial freedom, all these things, I have many of these topics on my channel, so make sure you subscribe to my channel and click the alert to make sure that you are alerted whenever a new video is being published. Thank you very much. Again, make sure you subscribe. Thank you.